Today we'll finish up risk management, and then we'll do our probably our last, maybe not last, but pretty close to last topic, which is asset valuation. Today we'll talk about valuing bonds. So in the class notes on page 64, we get to a new risk. Last risk was price risk. That was our first risk. We talked about how it's measured using value at risk, and its most common mitigation is correlation or diversification. Credit risk, which we're going to talk about bonds when we get to valuation, that's where credit risk really comes in. Credit risk is the risk that you have a contract with someone that owes you money and they cannot perform that contract. They cannot pay you, maybe because they're bankrupt, or they go into default, somehow go into default, and they can't pay you. So how do we measure this? Well, the most common way you've already seen on your project one, which is credit ratings. That's a common way to do it. I gave you the S&P and Moody ratings on paper one. We also had the Bloomberg probability of default. So you've seen this before. We'll use this again when we value bonds, because the credit rating will tell us what kind of extra risk the bond has and how much extra return we should be expecting from the bond. So S&P and Moody's, Bloomberg, the Altman Z is something you can very easily get your hands on if you want to look at a particular ratio for each company. So there's a lot of ways. Bloomberg has both the Altman Z and the Bloomberg probability of default. The way I like to talk about default risk is looking at ratings, and this is a really good way to understand how credit ratings measure risk. So this is a little bit dated. I wish I could find an update to this. It's just really tough to find an update, but it hasn't changed that dramatically, so it's still pretty accurate. And so you look back at a bond that's rated AAA, AA, single A. So AAA is the highest quality, and you look at the cumulative default rate. That is, what percentage default after 1 year. No AAAs have defaulted after 1 year, and very few single A and even triple Bs default after 1 year. Once you get down into really low quality things, you start seeing a higher probability of default. But what I like to look at is the 10-year. So these are good numbers just to remember. For a AAA bond, after 10 years, only about a little less than 1% will default. For AAA or AA, about 2.5% will default after 10 years. Single A, 3.6%. Triple B, you're getting closer to the 5 to 7%, 8%. Kind of depends on the bond. There's different levels within triple B, but just think 7%. So just 1, 2.5, 4, 7 might be a good way to think about it. When you drop down to double B, which is where this is the break between investment grade and below investment grade. So triple B is investment grade, double B is below investment grade. And I notice I'm saying double B when it's actually BA, but we tend to talk about them being triple A or triple B. But S&P is all A's and all B's. So S&P would be BBB, all capital letters. Moody's uses a capital letter plus the smaller BAA is what we call it. So here they're looking at Moody's, so you can see down at the bottom that it's Moody's. And so because they're using Moody's, you see Moody's ratings. So when you get down to the below investment grade, you can see almost 1 in 5 of the bonds will default. When you get to single B, over a third, and when you get down to triple C, which is really risky, that over half of those bonds will default. So yeah, credit ratings actually do a really good job of measuring your risk, because you can see as you go down in the credit ratings, your probability of the bond defaulting, that you actually have credit risk, increases. And once you get down to what we call below investment grade, or junk bonds, or high yield bonds, whatever you want to call them, your risk of default goes up dramatically. I mean, it's like 20 times higher than it is for the AAA. So the probability of default, that gives you essentially the frequency. What's the chance this bond's going to default? So that's frequency. But just because a bond defaults doesn't mean you lose 100% of your money. So there's what we call recovery rates, and that gives you the severity. So, you know, with a AAA bond, your probability of default is 1% over 10 years, so 0.1% a year, really low. But if the bond does default, the nice thing about AAA bonds is they have a lot of collateral. So even though it defaults, you might get 56% of your money back even then. So it goes in default. Now you are a creditor, you're standing in line, you say, okay, I loaned you money, you went default, I'm going to get as much of your assets as I can get, and that's your recovery rate. So AAA bond might have a 60% recovery rate, very low frequency, less than 1% over 10 years, and if it does default, you'll still get maybe 60% of your money back. A double B bond has a 20% chance of default, very high frequency, and if they do default, you might only get 40% of your money back. So you can see the frequency and severity, they tend to work in lockstep. Bonds that have a very high frequency of default also tend to have low recovery rates. So we're going to talk about spreads. The spread is how much return, extra return should you get because of the risk of default, the credit risk of the bond. So it has to do with the probability of default times 1 minus the recovery. So if your recovery rate's 60%, then your actual loss will only be 40%. So you combine those two together, which we get back to the AAA, you know, over 10 years, the AAA was 0.0087. That's your probability of default, and you'll probably get 60% of your money back. So if you put all that math together, 40%, you know, we're talking, you know, 0.35%. You don't need much extra spread to cover you for the risk of a AAA bond defaulting, because they don't default, and when they do, you get a good recovery. You notice those terms we're talking about, frequency and severity. We talked about that earlier when we first introduced risk management. How do you mitigate it? Well, you have risk limits. This is what we use where I worked, where you say, hey, you can't have more than, say, 3% in any given bond. The way we did it, we said, okay, if it's single A, double A, or triple A rated, we can have as much as 3%. And that bond, if it's triple B bond rated, we can only have 1.5%, and if it's below investment grade, we can only have 0.5%. So we would have our concentration limits were based on ratings. So the higher the quality of the company, the more we could have in that company. You could also have restrictions based on industries. So you might say we don't want more than 15% of our bond portfolio all in one industry, because we need diversification. So you can have aggregate limits that you look at every single thing, and this is kind of tough. I did this when I was at UTSA. It was tough because you want to look not just at what you have exposed loaning them money in a bond. You know, a bond is when you loan someone money and they owe you money. That's what a bond is. It's also called fixed income. So you have that exposure, but you might also have some invested in their stock. They may be a tenant in some real estate that you're lending out. They may be an important vendor that sells you a product and provides services. Maybe you've spent, you know, $50 million on their computers, and they're the only ones that can service your computers. So if they go insolvent, you're going to have to buy an entirely new computer system. You might have counterparties. There's other people involved. When you do certain transactions, and maybe this particular entity, they're backing the transaction. I don't want to get into counterparty risk here. I talk about it in my risk management class. It really relates to things like derivatives, futures and swaps, things that we really won't get into in this class. The big issue we had at UTSA was reinsurers. We had a CEO come in, and he said, I want really low credit limits. And because of that, we had to go in and really diversify our bond portfolio like we had never done before. We went from like 50 bonds to over 500 bonds. It was really quite a huge undertaking. But when we did that, when we looked at our biggest exposures, our bond exposures declined, but our reinsurers increased. What is a reinsurer? Well, for UTSA, a reinsurer is when an insurance company buys insurance from another insurance company. And so UTSA buys reinsurance from firms to protect them from major catastrophic losses. So They may buy some reinsurance from a really famous firm called Swiss Re, and they may say, hey, Swiss Re, we need your help. If we have a hurricane that costs us more than $2 billion, we want you to pay all of our losses over $2 billion. And that's what a reinsurer does. So we were looking at our exposure, and our biggest exposures after the new CEO came in and made us buy more bonds. Our biggest exposures, like 3 of our top 10 exposures, were reinsurers. Firms like Swiss Re and Gen Re and Munich Re. And how do you handle that? So we had this struggle with that. So you really want to say, what happens if this firm goes bankrupt? How many different ways can they give you losses? So USAA, just by just knowledge of what industry you're in, our bond investors and stock investors did not buy reinsurers. We did not want more exposure, so they didn't, and they didn't loan to reinsurers. They made sure to stay out of that market. That our only exposure to reinsurers was the reinsurance we bought from them. Now you can certainly have covenants. You're kind of stuck with whatever's in the covenant, but a covenant might say this firm can't pay dividends if they don't have at least this much in net worth, or those things to try to protect the bondholders from management doing things that harm them. You can actually buy insurance. There's something called a credit default swap, well beyond the scope of this class. But if you're a finance major, you might look them up. I don't like credit default swaps because they don't. I'm a big fan of swaps. We talk quite a bit about swaps in my risk management class. I love them. I used swaps when I was at USAA. I've never done a credit default swap. I've only done interest rate swaps. But you can, it's like buying insurance on a bond in case it goes insolvent. The credit default swap steps in. So it's just like insurance on your car. You wreck your car, the insurance company pays. Credit default swaps, it's like insurance on a bond. If the bond defaults, goes under, you get reimbursed. So we'll see this a little bit more when we price some bonds, and you'll see exactly how we capture that credit risk. The last risk I want to handle is an all-encompassing one. It's like everything else that we haven't talked about yet. So operational risk. And this is the risk that you have procedures or policies and they're not followed, or they're poorly designed, and you have a major risk. And there's just so many examples of this. It can be internal controls. Some of you are accounting majors. You might get into auditing. Auditors audit internal controls. You're worried about theft. Rogue traders, that's someone doing a transaction they're not allowed to do, and it causes you large losses. Could be some system failure. Several years ago, a firm named Bats had what's called the flash crash, where they had I think that day the stock market fell like 10% in a few minutes, all because of an error someone had made at Bats. It was called the flash crash. I was unfortunately teaching a class right when that happened. And so I go in to teach a class. While I'm teaching class, the market falls 10% and comes back to 10%. So it lost 10% and came back. If I had seen that, if I had been home, I probably would have done some transactions. When I see something like that, boy, I usually say, wow, this is a great opportunity. But unfortunately, the entire crash and recovery all happened during my class. Société Générale is a really interesting one. It's a French organization where one guy did some transactions that caused massive losses for that firm. And the interesting thing was, he didn't do transactions that he personally benefited from. There was nothing in it for him. He did it entirely out of spite. He just didn't like the company, and so he decided he was going to cause them some trouble. So you could look that one up. Barings Bank, Nick Leeson, there's actually a movie about him. There's a book out called Rogue Trader, and then they made a movie about it. Very interesting. And why did it fail? Well, the audit function fell. Here's an example of the accountants failing. The auditors did not do their job well at all because of what Nick Leeson was doing. It was very complicated. It was really hard for the auditors to figure out. And if you read the book, the book is written by Nick Leeson with a ghostwriter helping him. His view is maybe a little skewed because Barings Bank says he didn't tell the truth in the book, so you have some debate. But his argument, his recollection is that the best auditor at Barings Bank came to his office, was going to audit him. Nick thought he's in trouble. It's like, the gig is up. This lady knows what she's doing. There's no way she's not going to figure out what I'm doing. And he was ready just to turn in his employment card and be fired. But right before she came into his office to start the audit, she got called back to London. Nick Leeson was in Singapore, and her understudy was now in charge of the audit. She had to go back and lead the audit, and her understudy thought Nick Leeson was the greatest investor in the world. He just thought, he did not have a good auditor's mind to actually challenge. So I recommend, if you're an accounting major and you're thinking about auditing, there's a good book to buy for your friends, Rogue Trader, because it's all about the audit function failing. The Exxon Valdez, that's an operational risk. The Exxon Valdez, you had a guy who was intoxicated driving this massive oil tanker, and there was a major spill, and it causes just incredible damage to Alaska, to the shores, to the sea animals. Just horrible multi-billion-dollar cleanup. They had to change their procedures, including making sure their drivers or their captains weren't influenced by substances. 9/11, there you had a case of if they just locked the cabin doors. And 9/11 is a good example of how risk management, when it's done well, the people who do it well get no credit. So someone before 9/11 has said, "Wow, we've got to start locking cabin doors. We have this risk of a hijack, and we just got to lock." The chances are the airlines and the pilots would have complained. The airline says, "This can be real expensive for us to retrofit all these airplanes to lock the doors." The pilot's going to say, "Why can't you just trust us to do our job?" People would have complained. It would have been talked about bureaucratic overreach, the tough hand of government stepping in and telling us how to do our business. But it would have prevented this massive loss. But if it had prevented a loss, no one would ever know about it. And that's the downside of doing risk management well. No one knows about it. But the other thing is, after they changed it so you had to lock the cabin doors, then you had this famous airline, very sad story. You had two pilots in the cockpit, and one of the pilots leaves to go to the restroom. The other pilot keeps the door locked, and he actually crashes the plane. And a suicidal, not any kind of related to any particular organization or any particular political goal. He crashed the plane just because he wanted to end his life, and he decided to take a lot of people with him. And it's just so what do? So you lock the door to protect yourself from a hijacker, and now you got the problem of, what if the pilot's the problem? So you have to think through all these scenarios. It used to be on airlines, you don't need to lock the cabin door, because if someone hijacks you, they don't want to die. So they may take you somewhere, and you'll land, and they'll do whatever they want to do. Maybe they have their demands, but then you have this situation with 9/11 where the hijackers are actually going to take their own lives. That changes the whole risk management function. And then you think about a pilot crashing his own plane. Then you got to think, can you possibly come up with enough controls that you can think of everything? What if you have a sky marshal on the plane? Here's someone on the plane with a gun, legally allowed to have a gun, a sky marshal, and what if they're having problems? What if they're suicidal and have something horrible happening in their life, some mental illness is going on? And so there's almost no way to get these things perfect. I know with some of the school shootings, people are talking about teachers carrying guns, but you think about that, and boy, that to me, I think would cause far bigger problems. The few times you actually have school shootings, having teachers with guns might help with that, but those are such rare events. But there's so many other things that could happen, having guns on campus with all these kids, and teachers not being well trained, and who knows what a teacher's going through. So that's the tough thing of operational risks. You've got to try to think of every single thing that can go wrong, and that's really tough to do. The hiring side, human resources can be an issue. It's real frustrating for me. When I interview, I used to do a lot of interviewing for USAA, interviewing accounting and finance majors. I like to go off on tangents and ask questions, some of them you've seen in this class, just to see the student's understanding, and whatever the student says, then that takes me off on another tangent. I just want to see how well they've grasped the theories that they've heard in undergraduate. But USA didn't want me to do that. And the reason is they wanted to make sure I asked every person the exact same questions. That way, one candidate can't say, well, you didn't hire me because you didn't ask this question. You asked them the question, you asked me, I would have aced that question, so that was unfair. You didn't treat me correctly. So, firms have got to figure out how to deal with this. Reputational risk, bad press, firms get something hits the news that is just very negative for reputations. We've seen headlines where the FBI shows up to the corporate office to arrest their officers. That's never going to be a good headline. Lawsuits, there's a lot of massive lawsuits, whether it's the tobacco companies. McDonald's has been threatened to be sued because of how unhealthy their food is. Those are always issues. Operational risk. A lot of these are not insured or not insurable because these companies are too big. So a good example, British Petroleum. This is a firm who also had an oil spill in the Gulf of Texas. You may not remember this. This has been several years now, but you can go look it up. It happened in, it's 10 years ago. So y'all were still in middle school back then. But in 2010, in April, they had this massive oil spill that cost them billions of dollars. It's still having an implication today. They still have lawsuits that they're paying. Here's an article I found from British Petroleum. These are their excuses. They said it was a perfect storm of aging infrastructure. They said they had been overly zealous on cost cutting. They learned their lesson. They're not going to do that. Risk has to come first, risk management. They had risk blindness. They weren't looking at those close calls they had and to see that, wow, if that had turned out differently, that could have lost us a lot of money. They said they concentrated on the form and not the substance of regulation. They were just going through the motions. Ignored warning signs. That's one thing I do personally. I recommend that you do it, that you take note, very explicitly take note of close calls. I do that with my bike riding. I used to ride my bike down a certain road that was somewhat busy, and boy, there were some close calls of cars coming right next to me because there's 2 lanes and not much of a shoulder. And so I had to stop and say, okay, this is not, I'm riding this road every single day. Eventually, something's going to happen to me. You got these, and there was these big 18-wheelers because there was a quarry at the end of the road. I thought, this doesn't make sense. So I sat down with the map and said, okay, what is a safer route? And just look at that. And so I found a safer route, and yeah, that was the warning signs, close calls. So you have something close almost happen. There's some videos I love to watch. They're videos of car accidents, and just watching them, you quickly, after you watch maybe 10 or 15 of them, you start getting a sense of what's the biggest risk when we drive. And the biggest risk when we drive, the number one is at signal lights. When we're at a stoplight, that's the most dangerous point. And so I've gotten, when I'm driving, just seeing all those videos of people crashing, I see that as a warning sign, so I'm very careful before I start at a red light when it turns green. They said they were putting profit before safety. They insist there was no overarching failing in risk management or culture. There's just all these things. So are they better at risk management now? Well, I lied to you. This article I found was not written after the 2010 incident. This article was written 4 years before that in reply to other risks that they had experienced, other major losses they had experienced. So here they're saying, we've learned our lesson, and they're saying that right before the biggest loss in their company's history. And each one of these things apply to the 2010 incident. Aging infrastructure, overly zealous costs, all of this applies, and yet they still miss it. And I got this quote from an article says we only really address risk adequately when in the middle of a crisis, but that's not the time to do it. Like me with my bike riding, I'm not going to wait until some car hits me and then I'll address risk. I'm going to find another route. I'm going to find something that reduces my frequency, reduces my severity. Maybe it takes me an extra 2 minutes of bike riding to go around and do another route. I now go through a parking lot, a massive parking lot, so I can stay off the road almost that entire road. I only have to ride on that road for a little bit. Far, far better, but I had to go out and seek that. So risk management is you assess where you're exposed and what are the alternatives. What can you do? So how do you measure this? We just tackle value at risk. Can you use value at risk for something like BP's exposure to an oil spill? And it's really, really tough to calculate a value at risk for something like this. These are really, really tough things to measure. The famous software company SAS, I asked them that question. I said, how can we measure operational risk and put it into our models? And they said, no problem, we've got a model for that. So I met with them, and their model was, yeah, you give me the risk and the correlations, and you give me all these numbers and plug them into our models, and we can calculate it. And I thought, I could do that. I can get into Excel. Y'all saw how easy it was to calculate VAR. Remember, all you needed was the mean and the standard deviation. Correlation is if you have more than one thing to worry about. Well, what's the standard deviation of the potential for an oil spill? It's just almost impossible. So the meeting with them was interesting, but I went away thinking, you guys are saying your model needs inputs, and I'm asking you how to come up with the inputs. I know how to calculate a VAR if I've got a mean and a standard deviation. I can do that already. That's not very difficult math. The problem is coming up with those numbers to put into the model. So again, measurement, a key one is close calls. There's several examples historically where, 9/11 is probably a good example. The Twin Towers were actually attacked a few years earlier than that. There was a bomb placed into the parking garage of the Twin Towers, but it didn't cause much damage then. But you then knew that the Twin Towers were a target, so maybe you could have been, and there were certainly many warning signs that our federal risk managers, our government, did not catch on and didn't follow through, and we're somewhat at their mercy that they do their jobs well and they didn't. How do you mitigate it? You have to have just incredibly good procedures. So if you're an accounting major and you get into auditing, you don't write the procedures, but you're going to audit to make sure everybody's following the procedures. Procedures can become extremely unwieldy, so I would really recommend, if you're an accountant and you become an auditor, always step back and say, don't just see if they're complying with the procedures, but always ask, are the procedures actually working well? I remember one audit meeting I had, I thought it was pretty ridiculous, but it came out of Sarbanes-Oxley. And what they did in the audit function is they came and they reviewed our process, and they wanted to tell us what our biggest risks were, and so we had a meeting with them. And this guy, Michael, in my department, created a brand new report. And his report was important to our process. He ran it every single day. It told us where we were in our relative competitive position. It was an important report. And that was their big write-up on my department, was what happens if Michael's sick? You don't really have anyone to back him up. And I just looked at him and said, that's the biggest risk you come up with? I mean, if Michael created this report 2 years ago, so 2 years ago we didn't have it at all, and we functioned, we could make it quite a while without the report. And I mentioned to them, do you realize USA has authorized me to do trades where I could do one trade and bring this whole company down? That's pretty dangerous. And I was working on procedures right then, so that I couldn't do those trades. I couldn't do a trade that was too risky. And I had to put all the procedures in place, but USA allowed me to do trades that could have been just devastating to the company. I mentioned Société Générale, the French bank. You should know entity like a USA or JP Morgan, Credit Suisse. There's a big article in Credit Suisse here just recently. They had a multi-billion-dollar loss because of what one person did. A firm like a USA, Credit Suisse, JP Morgan, There should not be one person that can do a trade that can destroy the company. If you look at AIG, they went under in the 2008 crisis. Boy, yeah, it was a small department of, I don't know, 3 or 4 people that brought that entire massive company down. So make sure you're focused on the right things, that you're measuring the right things. So you as an auditor, I think sometimes auditors forget to step back and ask, is it even valuable? What if we met all the procedures perfectly? Would we still have risks we should be worried about? Do the procedures actually make us complacent because we think, oh, we got procedures, don't worry about that? And so this was my approach. I actually did this. I sat down and thought, how could I destroy this company? What trade could I do? And it became really easy. At the last few years of my career there, I'd gotten a great reputation. People trusted me. And when I asked to be able to do derivative transactions, which are very, very risky transactions, they were like, yeah, sure, it's Ron, we trust him. And I actually had to put my own procedures in place to make sure I did not do trades that would be too risky. And then I went to the CEO and told him, you gave me authority to do these transactions. I had to put my own procedures in place. I wanted him to know that they had just given someone incredible power to do major damage. And, you know, they may say, well, we trust you, Ron. You've been here years. You know the company. We trust you know your risk. But like the guy at Societal Generale, he was a good employee, but he just had a really bad week. He was really upset. Someone did something to him. Who knows what any particular person in the company is going through. Everyone should be restricted in what they... Even the CEO shouldn't be able to just pick up the phone and do a crazy trade that could bring the whole company down. When you're measuring how well you've done, focus on process. Some firms say, wow, we made this decision, everything worked out fine, so that was a good decision. It could have been pure luck, and especially in finance, there's a lot of luck. And what finance does, unfortunately, is we reward performance, outcomes, even though the math shows there's a good chance it was pure luck. And I recommend books by Nassim Taleb, The Black Swan. I really like Annie Duke's book, Thinking in Bets. Annie Duke especially, she calls it resulting, that we have this tendency to say a decision was a good decision because the outcome was good. But just because the outcome was good doesn't mean the decision was good. It could have been pure luck. So you always want to question. So focus on the process. Was the process good? So let's say we did something and it worked out by pure luck. It was a bad decision. Let's acknowledge, yeah, it's great it worked out. We like that. We like to get all that extra money. But let's not let it happen again. Because we can't rely on luck the next time. So performance is actually very unreliable. And then one of my favorite things to do, and this is tough, it's kind of what I was talking about up here, is go to the extremes. Think about the extremes. What happens if this happens? What if oil prices shoot up 50% overnight or in a few weeks? What if we hire an employee that has a reputation, whether it's sexual harassment or whatever? We talked about the Texaco case earlier. Boy, I could tell you a story of, one story I could tell you in particular, a guy who was in line to be the next CEO of UTSA, and boy, I learned things about him that I'm just so thankful he didn't get the job. Another person came in and got it instead of him. It was a really good CEO, and the guy that was thinking he was going to get it, he just left the company. He was so mad. But boy, the stories I could tell, what I learned about him, especially after he left, just an encounter I had with one person that he did some things. It's like, boy, I'm so glad that wasn't our CEO. But that's what boards have to think about, and management. You know, you're hiring people that are representing the company. They're going to make decisions. What is it that they're doing that could really topple this entire firm? So think those extremes and do it often. Have some process to go look on the downside of what could happen. And obviously risk controls, risk avoidance, risk prevention, risk reduction. We talked about those. And you got to be careful of the interaction. It's possible that you could actually reduce severity but increase frequency. And there's other times where you could reduce frequency but increase severity. And a good example is one city had 2 bridges, and one of the bridges was getting really in bad repair. So the city closed that bridge so they could repair it. That transferred all of the traffic to the other bridge, and that bridge collapsed because it just could not handle that extra weight and the extra traffic. So, they thought they were reducing frequency. I don't know in that case if it's frequency or severity, but they thought they were reducing risk, and they were actually increasing risk. So you need internal controls, policies, auditing, those kind of things to make sure. As I always like to say, every single employee in the firm is a risk manager. We're all responsible for risk management. I have a job as risk manager for UTSA. If I see a student that's not being treated well, there's something that could do them harm, physical harm or mental harm, we all have a responsibility to step in and say, hey, that's not right. And if it's really serious, you say, hey, we need to go and report this. And if they don't want to report it, what are the rules? So if you see something like that, what is UTSA's policy, procedures? What are the departments you can go to? How do you ask questions, and making sure you know what those are? I have to go through compliance training every year as an employee of UTSA. This is what we have for these particular risks, and this is what you need to watch out for. All right, so that's risk management. I could go through a whole lot more on risk management. So if you're curious about this, take my risk management class. It's my favorite class to teach because there's so much we can do here. Okay, so here we're going to change gears, and we're going to go into a whole new topic, asset valuation. Some of you, this might be your only finance course, so I definitely want to cover this. So when you get your 401k plan, or whatever investing you're going to do, maybe you have a Roth IRA, that we at least cover this. How do you value an asset so you figure out whether you want to buy it or not? And the value of an asset is what we've already been talking about. It's just the present value of future cash flows. So we talked about the cost of capital. We have our discount rates already. We did the capital asset pricing model. We talked about a bond. Well, we already talked about spreads, right? We had the risk-free rate plus the spread. We've already gone through that. So we have a discount rate. Now we just need to forecast those cash flows. So we need to value the security. So you might ask, why are we valuing the security? We already know its price. Well, we're valuing the security to figure out what we think it's worth. What is the intrinsic value to us? So if we think a stock's worth $90, but we can buy it for $60, the market price is $60, our intrinsic value is $90, then we definitely want to make that trade. So we're valuing it to try to figure out the intrinsic value. Now, when we do bonds, we're actually trying to figure out the current price. We're not actually doing intrinsic value. I'll talk a little bit about that. We're really just trying to figure out what's the price of the bond given what the market thinks. On stocks, though, we will actually look at stocks and look at them in a way to say, hey, what do we think the stock is worth versus what we can buy it for? So of course, if you buy a security, you're buying it because you think it's a good deal. You think it's mispriced. You always have to remember, though, whenever you pick up the phone and call your broker and say, hey, I want to buy 100 shares of Apple stock, the person selling you Apple stock, they're on the other side. They're saying, hey, I want to sell 100 shares of Apple stock. So you think Apple stock is going to do great and you buy it. The person selling to you thinks Apple is bad and is going to do horrible. Well, you can't both be right. So each believes their own valuation is correct one. That's why markets work. You have a disagreement. If there was never any disagreement, there would never be any trades. So just remember, anytime you buy an investment, you're investing in something that someone else disagrees. Especially if you're buying stocks and bonds, you're buying them from someone who's selling them to you because they think that's a good price. They think you're overpaying. You're buying it because you think you're underpaying. It's this tug of war. All right, so the value of security is the present value is future cash flows, discounting at a rate that reflects the riskiness of those cash flows. We talked about that actually the very first week of class. So let's start with bonds. So for bonds, the nice thing about this is the data is pretty easy to get. We're gonna talk about something called the market yield. I'll explain that and show it to you here when we do our example. So if you want to buy a 5-year Treasury bond that was issued 3 years ago, so there's only 2 years left, then we just say this is the 2-year bond. All right, so you're going to see the cash flows we're going to forecast is just the remaining life of the bond. So if it's a 5-year bond but it was issued 3 years ago, from our standpoint, it's a 2-year bond. So how many cash flows will we get? Well, with bonds, treasuries, and corporate bonds, we're just going to assume they pay twice a year because that's what they almost all do. That's a pretty important concept. So what do they pay twice a year? Well, they pay the coupon twice a year. All right, so this is how treasuries and corporates work. You'll see, don't worry about it if it's not, don't memorize it right now because you're going to get it when you do the Excel example. So bonds pay coupons twice a year, and then at maturity they pay your whatever the face amount of the bond is. And that gives us some other terms: par value, principal value, maturity value, face value. Those all mean the same thing. And I say all 3 terms, and I actually gave you 4. So I must have added one before I realized I added one. So all 4 mean the exact same thing. It's how much you get when the bond matures, which is going to be the face of the bond. That's why we call it the face. It's the principal amount of the bond. So what are you going to get? You're going to get coupons twice a year, and then the very, very last, at the very end, you'll get the coupon plus you get your money back. We're going to assume all bonds have a face amount of $1,000. And that's just the standard. That's the way bonds are usually priced. So I'm also going to assume you buy the bond exactly 6 months from the first payment. Now, in your accounting classes, you'll probably have the interest amortization method, and they'll show you that in accounting. We're not going to handle that. I'm going to keep it simple. I don't want you having to deal with sub-periods of interest and whether you use the simple interest method or the compound interest method. I'm just not going to handle that. So if you can understand how to value a bond, then that's good enough. And in your accounting classes, you can see what happens if the first cash payment's 2 months from now. How do you handle that 2 months? What do you have to pay the person selling you, since they're not going to get that coupon? They've waited 4 months, and now they're selling the bond. If they just waited 2 more months, they would get the coupon. Now you're going to get the coupon. You're going to essentially have to throw in an extra amount for the bond price to essentially give them 4 months of that coupon. And that's the way bonds are priced. But you'll see that in your accounting class. In intermediate accounting, you may not, if you're a cybersecurity, ever see that. I don't think it's that important that you know how to do that, though. All right, so I'm going to skip all of this because the easiest thing for us to do is to do an actual example. So I want to walk through an actual example in Excel. This is not the Excel exercise that you have in your application. I'm going to do a couple of Excel applications, maybe one today and another one the next day, and then I'll do one of the ones from your Excel application assignments. And I'm hoping this will look familiar to you because you have done this already. So if you did Excel applications 1, 2, 3, and 4, we've already done this. So let's look at a Treasury bond. Let's say it's a 20-year Treasury bond issued 15 years ago. All right. Let's say as a coupon, well, a 20-year Treasury bond issued 15 years ago, what kind of rate will it have? Here's the Treasury yield curve, and so we want to go back 15 years. 15 years would be what, about 2005? So let's go back to 2005 and say go. And we're in April. We're looking at a 20-year bond in April of 2005, so it's the second to last column. Kind of funny we didn't have 30-year treasuries back then. That's an interesting story. But so February, right here, we'll just use this one, 4.88%. So I'm going to use 4.88%. Why? Because when they issue treasuries, they issue them with a coupon right at whatever current interest rates are. So back then, interest rates were 4.88%. So what do we have to do? Well, the first thing we're going to do is we got to get the current market yield. Alright, so what is this? This is a 5-year bond. Right? It's a 5-year bond. Why? I know it says it's a 20-year bond, but 15 years have passed, so there's only 5 years left. So let's get the market yield. The market yield is going to be the risk-free rate plus a spread, but we know this is a treasury, so our spread, we already know, is going to be 0%. There is no spread on this bond because it's the risk. We're thinking the treasury is the risk-free asset, so we don't have to add a spread for credit risk. But we do need to go find the current risk-free rate. And let's go back to the current month, go. And so now we're looking for a 5-year treasury yield. And so there it is, it's 0.85. You notice that the 20 years dropped all the way down to 2.22, but this is no longer a 20-year bond, it's now a 5-year bond. So what are we saying here? Well, if you were to buy this bond, this 20-year bond today that only has 5 years left, what kind of discount rate do you use? You need to use a discount rate that's your opportunity cost. How much could you buy if you bought a 5-year bond somewhere else? What rate would you get? If the U.S. Treasury issued 5-year bonds today, they would have a coupon of about 0.85%. So you're looking at whatever the current market is. So that's going to be my risk-free rate, 0.48%. And so that gives me my discount rate. I just add those two together. Oh, wait, 0.0085. I don't know why I put 48 there. I don't even know where. I'm looking at the wrong number. Sorry. 85 basis points, 0.85%. So my discount rate is my risk-free rate plus the spread, since this is a treasury. So that's why I'm going to do a corporate after I do this one. The next thing we need is the effective yield. So step 2, determine the effective yield. And this is just a formula. So what is the effective yield doing? What we're doing with the effective yield is we're saying this bond pays interest twice a year, so we want to actually compound that interest for twice a year. You may have, if you've seen certificates of deposit and other similar types of securities, they may have an APY, an annual percentage yield, and that's exactly what they're doing. They're taking the annual number, but they're compounding it because you have it multiple periods. So it's pretty easy. The effective yield is just a formula, and it's always this formula for these type of bonds. The effective yield, what you're going to do is you're going to take 1 plus your discount rate divided by 2, and you're going to raise all of that to 2 minus 1. So essentially what are we doing? We're taking 1/2 because we get paid twice a year, and we're going to square it so it compounds on itself. You're making interest on interest. And that's exactly the formula for an APY. So we'll do 1 plus the 0.85% divided by 2, raised to the second minus 1. And make sure you see where the parentheses are. It's 1 plus that divided by 2. That whole thing, including the 1, is raised to the second power. Now, the answer has to be higher than the discount rate. You will always get a higher number. So in this case, you can see it went from 0.85% to 0.852%. Now this is for a corporate bond or a treasury bond that pay interest twice a year. If you are doing this for a CD, let's say you have a CD that pays monthly, and you want to know the APY for that. If it pays monthly, you divide by 12 and you raise it to the 12th power. Alright, so however many compounding periods there are, the effective yield, you divide by the same number, you raise it to the same number. All right. So when is it 2? When is it 2 here? When is it 2 here? Where if it's 2 here, if you're dividing by 2, you will raise it to the second power. Why we're using 2? Because the coupon is paid twice a year. On the CD, you use 12 because it pays interest monthly. All right. So there's our effective yield. So step 3 is we create the table. I'll call it the valuation table. And this might look somewhat familiar to you. So we're going to have in the first column time. In the second column we're going to have cash flow. The next column we're going to have the discount factor. This should look somewhat familiar. It's not exactly the same as what you had on Excel applications 1 and 2, but it's the similar type of concept. And then we'll get the discounted cash flow. Alright, so those are the columns that you need. So what is time? Well, I told you that we're going to pretend like we buy this bond exactly 6 months from the next coupon payment. So it paid a coupon like 3 seconds ago, and we're now going to buy the bond, and since they just paid a coupon, we don't get any of the coupon that was just paid. We'll get our next coupon in 6 months. Well, remember what 6 months here, we're going to that's half a year. Then you add another half a year, and this is a 5-year bond, so we're going to actually get 10 payments. So you go from 6 months all the way out to 5 years. And if it had been a 20-year bond issued 10 years ago, that would be a 10-year bond. Would go out 10 years. So it's 5 years, but it's 10 payments because we're getting a payment every 6 months. What is my cash flow? Well, the cash flow is very, very simple. The cash flow is just going to be the coupon divided by 2 times the face. What do we assume the face is going to be? The face for this bond, we always just assume it's $1,000. On the exam, I actually tell you to assume $1,000. But so what is my coupon going to be? Well, my coupon in dollars. So this is the coupon in percents. So we know our coupon here is 4.88%. So I'll take 4.88%, divide by 2 because we get the coupon twice a year, times my face. So I'll get $24.40, and I'll get that each time. So you can just keep adding that to the next one. So that's the first thing. You set up the coupon, it's going to be exactly the same for all periods. And then there's just one last adjustment on the very, very end. You'll also get your face back. So you've got to make sure whatever bond you do, you should have that kind of pattern. Alright, a coupon that's the same. The coupon formula, just to show you the formula. So there's your formula. You just take the coupon 488 divided by 2 and you multiply that by $1,000. So that's what's coming here. What's your discount factor? Well, the discount factor is going to be very similar to what we've seen before. 1 divided by 1 plus, here you use the effective yield, and you need to hit the F4 to lock it in, and you're going to raise it to time. And you should get something below 1. It has to be less than 1. Alright, let me copy that formula because it's a little bit of a messy one. And now we can copy that down. And you notice that the discount factor gets smaller and smaller and smaller. Why? Because $1 today, if we were absolutely at time 0, this discount factor would be 1. Alright, but we're not at time 0 at month 6. So month 6 at $24 is not going to be worth $24.40. We're going to bring it down about 0.42%. And as you go through time, the value of $1 is less and less and less. And so what is my discounted cash flow? We just take each of the cash flows times the discount factor. just multiply across. See what colors I've got left here. And then you can copy that down. And then the value of the bond is just the sum of the cash flows. And there's the value of my bond, 1196.87. And so there's my answer. That's my solution. That's what you're looking for on the example problem, on the Excel applications and on the final exam. You see, all we did is we forecasted our cash flows, just like we said we've been doing. We got our discount rate up here. We adjusted it for the fact that the coupons pay twice a year, but it's the same number, but we're going to actually use the effective yield, the value, and then we just take our cash flow times the discount rate, and that tells us what those cash flows are worth in today's terms. Alright, so we've got one bond down. We'll call this a Treasury, 5-year Treasury. So what else do we want to do? Well, the next one we want to do is a corporate bond, which is what you have to do in yours. We'll do example, I'll call it example A, and then when we get to the actual Excel applications, I'll give it the same name or however it's numbered there. I forget how many bonds I gave you. I might have given you 2 the value, but you can see once you get one set up, the format's all the same. All you got to decide is how many periods there are. If the period's 10 years, then you go all the way out to 10, and then every number will be the same until that very, very last period, and then you'll add the $1,000 back. So it's always going to look the same, other than the number of periods and then of course your discount rate. So we'll always use $1,000 for the value. The effective yield formula is the same for all bonds. There's no reason to change that. And this format is going to look the same every time other than the number of periods. So there's nothing really fancy new that we've got to do here. So we'll do a corporate bond example in the next session. The key here, if you want to try it on your own, let me set it up and then we'll work it next class. So let's say we've got a 15-year corporate bond issued 5 years ago. I would say, so what is this bond? This is a 10-year bond. What else can I tell you? I can say it was AA rated when issued and BBB rated today. Alright, so what is its rating? Well, it was AA when they first borrowed the money 10 years ago, but they've been downgraded since then. So our rating today is BBB. You see how we're only concerned about where we are today and how much is left. We really don't care what was going on 10 years ago. It's going to tell us what the coupon is, that's for sure, but it's you know, all we care about is what's left. This is a 10-year BBB bond. It was issued as a 15-year AA bond, but it is now a 10-year BBB bond. Obviously, their last 5 years have not gone well. They've gone from AA down to BBB, so that's not good. Alright, so let me give you a table that you'll be drawing your numbers from. I'll probably do something similar like this on the final, although it doesn't look quite what your example problems do, so I'll try to keep it as close to the example problems as possible. Let's look at Treasury yields. Let's look at a 15-year Treasury yield and a 10-year Treasury yield. Let's say the 15-year is 2.5%, and the 15-year is 2.5, and the 10-year, let's say, is 1.8%. And then let's look at spreads. Let's look at spreads for AA rated and BBB rated. Let's say AA 15 years had a spread of 35, 10-year has a spread of 25, BBB is 210 and 170. Alright. So what are you going to do? So I need a coupon, so let me give you a coupon. I'm just going to say the coupon is 7%. I'm not going to go back and figure that out based on what rates were 10 years ago. So now we need the current yield. Remember we did that with the previous one. I say market yield. Current yield and market yield are the same thing. I'll make it similar so it doesn't make it confusing. So market yield, remember what the market yield is? It's going to be the risk-free rate and it's going to be the spread. Alright, so stop and think about that. What is that? So that's going to give you your discount rate when you add those two together. You then are going to calculate the effective yield, and then you'll do the valuation table. So it's once you get down to the effective yield, you've got the coupon and the effective yield. This problem is exactly the same as the Treasury. So stop and think, which risk-free rate should we use? 2.5 or 1.8%? Is this a 15-year corporate bond or is this a 10-year corporate bond? And what spread do we use? Do we use AA rated for 10 years, 15 years? Or do you AAA rated for 10 years, 15 years? What kind of bond is it? So you should put those in there. One thing I'll tell you on the spread is the spread in basis points divided by 10,000. Alright, these are basis points. So if you want to convert this number, you just take the 210 and divide by 10,000. And that will give you your number, alright? So right here, you're going to figure out which of these four numbers you need for the spread. And if, let's say you pick the 35, you would take 35 divided by 10,000, and that what goes there. So we'll finish this problem up next session, but you have everything you need now. See if you can figure it out on your own. I love students that it's like, I want to be a self-learner, self-teacher. See if you can figure this out on your own without having to watch my video. And if you can, then next time I'll finish it and you can check your work, and then we'll also do one of the Excel applications.